Welcome to the Real Estate Show with Pat Lopez, where we talk everything real estate. Today, my guest is Brian Papigula, CPA at Papigula and Company.
Correct. Thank you, Pat. Good afternoon. Thank you for having me.
Well, welcome to the show. Okay, so I always start off the show by asking, how did you get started in your business or being a CPA? So tell me your story.
Well, thank you. After some years working for public accounting firms, I went out on my own.
Okay.
It was 1991. And right now it's myself, and I have four accountants as staff. We focus mainly on small businesses, doing a lot of the traditional accounting services, write-up, and personal and corporate tax returns.
Okay.
And I think it's an excellent business. I get to see a lot of different businesses. We have a lot of professional offices, dollar stores, gas stations, manufacturers, and we enjoy it very much.
Right. So it would be kind of interesting because you really get to learn other businesses.
Yes.
By diving into the books
Yes.
and everything. It's to me
Absolutely.
that'd be pretty fascinating.
Yeah. At its core, however, accounting is accounting.
Right.
Whether it's a professional office or a manufacturer or a dollar store, or a gasoline station, accounting's accounting. There's some intricacies naturally for each industry, but for the most part, it's all the same.
Okay, so this is a real estate show, so let's jump into some benefits and advantages of owning real estate, investment properties, and all that. But why don't we start off with a primary residence?
Okay.
If I own a house, what is a tax deduction I can utilize?
Okay. Well, right now, Congress has traditionally favored home ownership over renting. So rent on a primary residence where someone's living is not tax deductible to rent, whereas mortgage interest and real estate taxes are on that property. The benefit's been somewhat diminished over the last, I'd probably say about 8 years, because of the deductions associated with the home, a primary home, of course. The mortgage interest and the real estate taxes are part of what's called your itemized deductions. And each year on a tax return, taxpayers either itemize their deductions, or they take something called a standard deduction. Now, standard deduction for a married couple is $30,000, and for a single person, it's half of that, it's $15,000. And the taxpayer will take whichever one benefits them the most. So if their itemized deductions collectively exceed the standard deduction, then they'll go that route. But given the size of it, a lot of people, while the real estate taxes and the mortgage interest are deductible, they're not going to get a benefit for it because they're going to take the standard deduction.
Right, because it's
better
money.
because it's better. Exactly.
Okay.
Exactly right.
Okay, so then I also have a lot of people calling me up saying, hey, is it a good idea to take out a home equity loan? I have a lot of credit cards, I have a lot of debt, that kind of thing. And I generally say, once again, I'm not an accountant or a financial planner, but I end up telling them saying, hey, if you have enough debt and you can get a lower interest on that home equity loan, that may be a good idea. And the home equity loans are tax deductible, but is that mortgage interest?
Yes.
Or?
Well, let me address the economic perspective first. From an economic perspective, it definitely pays because the rate you're going to get is going to be substantially lower than even the best credit card rates. So just from a lowering in how much cash it will cost you each month, it's definitely beneficial. Downside to that would be now that credit card debt, which was unsecured, is now secured. It's now secured. Now, as far as the tax deductibility, again, this falls under the realm of if you are itemizing, you can deduct interest on your primary residence and a second home too, by the way, where you spend at least 14 days out of the year. The debt cannot exceed $100,000. So if you borrow to pay off credit cards and it's under $100,000, you'll be able to deduct that interest if you do itemize in full when you return.
And then once again, we're going back, does it make sense to itemize or not?
Right, that's right. Mm-hmm.
I really never thought.
And that came in the past. Home ownership was very beneficial, but when Donald Trump was first elected in 2016, in 2017 he doubled the standard deduction and he eliminated some other things. So that took a lot of people out of the realm of itemizing and put them into the standard deduction. So some other itemized deductions were disallowed. There's no itemized deduction any longer for work expenses, someone incurs as an employee. And now the real estate taxes and your state and local income taxes withheld from your pay collectively are capped at $10,000.
Right.
So That hurts a lot of people as
Yeah,
well.
oh, absolutely.
Yeah.
The high tax states.
Yeah. Oh, now some people are under the opinion that when Donald Trump first took office, that was his shot against California and New York. Traditionally very high state income tax rates and very high real estate taxes. Whether that's true or not, who knows? But that's kind of the
Right.
the theory there.
Okay, so let's jump into buying an investment property. Okay.
Okay, good.
And the benefits of buying an investment property and some of the tax deductions people can utilize, and maybe some things that people don't realize or they're missing. Because I do see a lot, like a perfect one is depreciation.
Yes.
I see some people not utilizing depreciation, so I sort of scratch my head on that. Okay, so in thinking about buying an investment property, what's the first thing you want to analyze? Like, is it a good idea to buy?
Well, yeah, that's exactly, at least in my opinion, what the first thing should be. Just ask yourself, why are you doing this?
Right.
Some people want to do it because they see the infomercials that come on very early in the morning that just extol the virtues of owning a property. In those scenarios, the tenant always pays. There's never any major repairs,
Right.
and there's no evictions, and everything's fine. So they could be seduced by that. But so you have to ask yourself why you want to do it, and hopefully the conclusion you come to is you want to do it to get a return on your investment,
Right.
to make money. It has to economically make sense. Don't buy it for the hope that, well, it's going to cost me money every month, but the property's going to appreciate substantially. Now, that may happen, but I wouldn't count on it. If it happens, it's an extra benefit. But you should buy a property for economic reasons and realize this is a business, even if it's one property, even if it's a duplex and you choose to live in the first floor or the second floor, it's a business. And you're going to have to deal with tenants and potentially evictions and tax reporting.
Now, do you have a formula to, if a client comes to you to say, hey, can we run numbers to see, does this pencil out?
Yeah, well, it's basically a return on investment calculation. If you could picture a numerator denominator, the denominator is how much you're going to have into the property through a down payment and maybe some fit out. So I'm just throwing out as an example, if someone has $100,000 into a property. And I would think to be involved in this business, you'd want at least a 16 or 17% return on your money. So if you do have $100,000 into a property, you'd want your cash flow to be around $16,000 or $17,000, yeah, to get into it, because it is going to be a lot of work. And like I said, don't be seduced by what you see on television and those seminars and infomercials. It's a business, and you want to get paid for it. You want to make money on that. The ideal situation is your property generates a good amount of cash flow, and the depreciation on the property shelters that cash flow, meaning the write-off of the building and any other improvements that you make. To shelters that cash flow from a tax point of view. So if you get 15 or 16% cash return on your investment and it's sheltered, then that's tax-free.
Right.
That's when the system works.
Right.
The business model, it's a simple business model, but you just have to be aware of the intricacies that could cause it to not work.
Right. Okay, so now buying a house personally or putting it in an LLC or in a corporation, that kind of thing, you can take ownership in any of those formats. Now, as far as a loan perspective, if you take it outside of your personal name, then you're doing more of commercial financing. Just, throwing that out there generally, not all the time, but generally. But what are some of the reasons why you would, buy a home or an investment property and put it in an LLC?
Okay. Well, if you've made the decision to purchase a property and you've identified and located one you think you want to proceed with because it looks good from an economic point of view, I prefer purchasing it as an entity. My choice is an LLC. You're still going to have the corporate protection of a regular corporation, but much easier on the reporting side, particularly if one individual is going to be the sole owner. But the key is to purchase the property as the LLC. You want to avoid purchasing it as an individual and then later on transferring it to an LLC. You may be in a locality or state with a high realty transfer tax, like Philadelphia. Philadelphia is going to be over 4%, 3%, a little over 3% to Philadelphia, 1% to the state. and, you'll be subject to it, even though you're the sole owner of the LLC.
Right, so let's clarify that. So if you have an LLC and you want to transfer it to your personal name
Yeah.
or vice versa.
Vice versa,
or vice
particularly, yeah.
versa, You're paying that transfer. tax, 'cause
Absolutely.
that entity is like
Even-
selling it
yeah.
to, Joe from down the
That's
street.
right. And unlike a sale of a purchase of property where it's traditionally split between buyer and seller, you're on both sides of the
Right.
equation now. So if that property appraises out at $200,000, that's $8,000 just for transferring it out of your name. So I always like to see the individual purchase it as the LLC. The LLC should be the purchaser and should be the applicant on a mortgage if you're going to apply to give a mortgage to a
Right.
lender.
Right.
Now, there are some banks that still push back against having the LLC as the applicant. Even though the owner of the LLC, the sole member, is going to personally guarantee the note, they still push back. But much more banks nowadays are lending on with the LLC as the applicant. Now, they're still going to ask the owner to guarantee the note, of course.
Right.
Of course. So it'll be all the same things as a traditional if it was just in the individual's name. But you have that corporate protection where, God forbid, there's a lawsuit. At least you won't be named in the lawsuit.
Right.
You'll be the LLC will be named. And if God forbid there is a judgment over and above your insurance policy limits, you can't. Your personal assets are not on the hook yet.
Okay.
So that's important.
Okay, so now I bought the property. I'm renting it out. What are some deductions that you can take? And it's almost, there's a ton. So
Oh yeah, sure. Well, first off, it's very, very important to keep this business separate from your personal business.
Oh, there you go.
Don't commingle anything. So set up a separate bank account in the entity's name, and it's very easy to do. Obtain a federal identification number. Sometimes it's called an EIN or Fed ID. Same thing. Those terms are used interchangeably. You can get it very easily on irs.gov, and to open up your separate bank account, the bank is going to want to see the IRS letter assigning you the identification number and your stamped articles, your articles of formation. Then once you have that, everything will be kept separate. So if you have to fund the entity bank account, the LLC bank account, don't pay things out of your own personal account. Contribute money to the LLC and then run everything through the LLC, the rent you collect and the expenses you paid. And anything associated with the property is going to be tax deductible.
Right.
Now, it might not be deductible in the current year. It may be written off over time. It's called depreciation, depending on the nature of the expenditure.
Well, let me just elaborate a little bit and we'll jump into the depreciation on that. But so if you're out there, you have to, shovel snow, anything you buy, you're driving, commissions, if you're renting up,
Absolutely.
pretty much, there's a ton of things. Anything that you're doing with that property, you have receipts, you're paying people, that is a deduction.
Absolutely.
Right?
Anything related to the property is deductible, but naturally, of course, you have to have documentation for it.
Right.
That's why it's good to run everything through your bank statement. Even if it's an online payment, that's fine. That's fine. That's substantiation because it shows right up on your bank statement the nature of the expenditure and to whom the payee was. Or a canceled check, too. That's fine substantiation. Also, too, something where it's not out of your pocket, but keep track of your miles. Inevitably, you're going to have to go to a Home Depot or a Lowe's or some kind of supply house. You're going to have to interview tenants. You're going to have to run a lot of places for this, and the standard mileage rate is 65 cents per mile. So just keep a good mileage log, nothing fancy. You could update it once a week. Keep it on a Google note sheet or an Excel spreadsheet of from where to where and the number of miles. And make sure don't inflate any of those numbers, because if it's ever looked at, IRS agents, they go right to a MapQuest type site and just say, oh, you put from here to here, well, you have 300 miles, I only get 80 miles, something like that. So just be legitimate in that, and it's a nice deduction. It's 65 cents per mile. And that's all legitimate, but I can't overestimate the need to keep a separate bank account and don't commingle things with your personal return. Sometimes it's not so much a tax thing, it's a legal thing. If God forbid you need that legal protection, you don't want a plaintiff's attorney to say, well, he or she is commingling funds. That's not really a separate entity, it's just this person's alter ego. So therefore, there's no corporate veil, and now I could get at the individual owner. So.
Okay, so now, let's get into depreciation. And if you do a major improvement, how you can't write it off that year.
Correct.
You'd have to depreciate it. So just get into some
Sure,
of that.
okay. Well, first off, when you purchase the property, the first item of depreciation, not so much calculating the depreciation, but how much will be depreciable, is the purchase of the property. You know, if you, just as an example, if you purchase a property for $100,000, the cost is $100,000, but you have your closing costs. You're going to have title insurance that you're going to purchase. You're going to have transfer tax, other endorsements and notaries and things like that. And you may have to reimburse the owner for sales tax or real estate tax that was already paid. Now, those things collectively is your total initial basis. Now, what happens is that's allocated between the building and the land. Land is never depreciable. What's been accepted by the Treasury Department and the states is a kind of a safe harbor. It's a 90%, 10% allocation, meaning 90% to the building and 10% land. So if you purchase a property for $100,000 and you have maybe $20,000 of closing costs, you start with a basis of $120,000, 90% of that would be $108,000. That's depreciable. If it is residential property, that amount is depreciated over 27 and a half years. Commercial property is 39 years. And then going forward each year, if there is a fit out, as you mentioned, a major fit out, say property does need rehab, and your initial basis would be the same as I just mentioned.
Right.
But if there's a major fit out, everything during that fit out period is capitalized, even your soft costs, even your utilities and your insurance and things like that. Once the fit out is complete, then you can start depreciating the property. So there's no depreciation during the fit out period.
Okay.
Yeah, and of course there's not going to be any rent. So you would still file any necessary report like a Schedule E, but you would show no income and no expenses, not even depreciation, until the
How about
property
the
is
closing
ready.
costs and those kind of things when you bought?
That's part of your initial depreciable
Okay,
basis.
so-
Yeah, that was, yeah, that's right. And that's allocated 90-10. But then after that, it's all allocated towards depreciable something. And when you do make an expenditure that is depreciable over time, and I'm oversimplifying it, but as a general rule, anything that's affixed to the real estate is going to be that 27 and a half years. Other items like appliances, a microwave or an oven, refrigerator is going to be 5 years. Furniture is going to be 7 years. Little air conditioners, space heaters will be 5 years. But a heating unit is going to be the 27 and a half years. A new roof would be 27 and a half years, things like that.
Okay, and then as far as you own the property, you have to make sure you have all your licenses in place.
Yes.
PGW.
Yes.
You know, because PGW is a lienable item.
Yeah,
so if
that's
you don't
right.
have,
Yeah.
if you don't fill out.
The Philadelphia Gas Works has the landlord participation program. Definitely sign up for that. Otherwise, there's a risk if a tenant leaves with a small or substantial bill to the gas, because you could get it transferred to their name initially.
Right.
The landlord participation program is if a tenant leaves and there's an amount due, particularly a large amount due, you want the PGW to have access or an action against only the tenant that left, not against the landlord.
Right.
Water, of course, is always lienable against the property naturally. You can't transfer that out of your name as an owner. But Philadelphia as well, Philadelphia, of course, and this would come into play. Initially, a lot of people don't get these because it's easy to get a tenant in. This is one of those things where it comes up if there's a problem with the tenant, namely if there's an eviction. So first and foremost, very easy on the Philadelphia Department of Revenue's website, you want to obtain a commercial activity license because you're running a business in Philadelphia. And you're going to get a renter's license each year. The commercial activity license is once, it never expires. The renter's license is $50 per unit. You'll get that each year. And then you also have to have something called a renter's suitability license. It's easy to get, but you have to present that to the tenant when the tenant moves in, because it could present a situation later on if you have to evict the tenant. A tenant could say, I never received that, therefore you had no authority to collect any rent. Not only can't you sue me, I'm going to sue you for money that I paid you because you had no authority to collect that rent. And of course, get a lead-based paint certification. They're very easy to get. The city's website will list their approved contractors, and that's all of these are pretty easy to get, but you should get them even before you get the tenant, because as I mentioned before, there's some non-financial factors. This is, in my opinion, the major one is the tenant.
Right.
The tenant. If the tenant's a good tenant and they're there, they keep your property nice and they pay, it works.
Right.
The business model works. Assuming your numbers work to get in, it stays the form. And this is one of those things that you don't see on the infomercials,
Right.
the seminars where everything works perfectly.
Okay. Okay. So now let's jump to we're selling.
Mhm.
So when you're selling, what are some of the things you have to file when you end up selling?
Well, when you sell, you have to account for the sale, and there will either be a gain or a loss on the sale. Now, let me just back up 1 second. Each year, you're going to report your activity from the rental property on your tax return. Could be a profit, could be a loss.
Right.
If it's a loss and it's a residential property, the loss is deductible up to $25,000. There's some other exceptions if you're real estate professionals, but for this purpose, I'm just going to assume people are just casual investors.
Right.
If there's a loss, if your income is under $100,000, you could deduct the loss in full. When your income exceeds, your adjusted gross income exceeds $100,000, it begins to get phased out. It's phased out completely at $150,000. Now, the loss does not evaporate. It's kind of just sitting in the bullpen, for lack of a better word.
So you can use it.
So next year, if you have a profit, you could use that loss, or if it continues to show losses because of the depreciation, those suspended losses get triggered when you sell the property, which is a good thing. So if somebody has suspended losses of, say, $50,000 over the 10 years they've held the property, those losses get triggered when you sell the property, which is good, and they're deductible in full. Now, to answer your question, when you sell a property, you're going to have to account for the sale. The sale's going to have either a gain or a loss.
Right.
The gain or loss will be the difference between your gross selling price, because remember, you'll receive a 1099-S from the title company. So in terms of reporting, you'll have to report your gross sale, and that's compared against your basis. Now, your basis is collectively what you paid for the property, plus all the improvements you've made over a year, plus your closing costs to get in and out, and minus the depreciation you've taken over the year. So if you have a sale of $200,000 and you have an adjusted basis after you go through the calculations of $180,000, you have a $20,000 gain. And that gain is taxable for federal, state, and if the property is in Philadelphia, for Philadelphia purposes as well. Now, on the gain, and this is assuming you're choosing not to do any of the tax-free provisions, like an involuntary conversion or a Section 1031 exchange. If it's a fully taxable event, the gain will be taxed. You're looking at about 15% federal for long-term capital gains rates.
Long-term is over a year?
Over 1 year, if the property's held for longer than 1 year. 3% to Pennsylvania, and I'm rounding 4% to Philadelphia. So collectively, 22, 23% of the gain. So if you have a $20,000 gain, 23% that'd be about $4,600, $4,700. So it's not too bad, particularly if it's long-term. And, the ideal situation is the property appreciates in value.
Right.
And, you could don't be enamored with too much what you walk with, because you could just been paid off your debt. Your real gain is over and above what you paid for.
Right.
So, but if you have a good tenant and everybody pays and the operations funded your debt service and they put money in your pocket and you're able to shelter it with depreciation, it works. It's a good model. I can't overestimate how important, though, the tenant is.
Right.
The tenant, even if you have to take a below market rate to get a good tenant that is a much better tenant. Some people focus strictly on seniors.
Right.
They love seniors. If they're on Social Security, and particularly if they have some of the old style pensions, the defined benefit pensions, they can't get fired.
Right. As
long as they're alive, they're going to get a check. And so even if you take a below market rate, it's much better. Even if you have to put a chairlift in,
right.
if it's a 2-floor house, it's worth it. It's worth it. And seniors tend to want to pay their bills, and sometimes there's a lot of tenants out there who have unfortunately no problem living in your unit and not paying you.
Right. Okay, so let's jump into, since you brought up seniors, this is a question I get a lot. Okay, I have an elderly parent, owns a house. Should I put the home in my name so the senior care living place, whatever, won't take the house?
You mean in an heir's name, usually the child or children of the child?
Right. If you transfer or should we just put it in the will and wait to get the property afterwards? So what are those tax implications?
I get that question frequently as well, and my response is, if there's you have to address a nursing home situation first. If the nursing home could be a situation, you want to get it out of the parent's name. Pennsylvania, of course, has a 5-year look-back period. Whereas if you get it out of the parent's name before that 5-year period, they're still going to count the value of that house. Now, they can't reverse the transaction, of course. You know, they can't make it give that house back to the state. If they transfer it to a child, the child's living there. But they'll just make the parent privately pay the amount of what the value of the house up until that point. So you want to, if a nursing home could be a consideration, I usually recommend getting it out of the parent's name while they're alive, an inter vivos transfer, and to the children or to the child or the children's name.
Right, and there is that look back for 5 years.
Yes, correct.
So,
that's right.
So you have to keep that in mind.
Keep that in mind. Absolutely keep that in mind. And now what that does is it's out of the parent's name.
Right.
And assuming a nursing home is not a consideration or it's more than the 5 years. It's out of the parent's name. So if a parent does pass away, there'll be no inheritance tax, at least on that asset, because it's already out of their estate, and it's more than a year. For inheritance tax purposes, a 1-year look back. Things that get clawed back in the estate for 1 year. They try to avoid deathbed transfers to evade the inheritance tax. The downside to that is if the child or the children are going to sell it when the parent passes away, if the children receive the property during the parent's lifetime, they receive what's called a transfer basis, meaning the parent's basis. So that situation I spoke of a moment ago in accounting for the sale, now if the child wants to sell that house because they have their own, then now that the parents have passed, their basis that they compare against the selling price is the parent's basis, not a step up in value. Whereas if a child inherits the property from the parents, yes, there will be an inheritance tax at 4.5% if it's Pennsylvania, but they will get a stepped up basis. Stepped up, the basis now becomes the value of the property at the death of the parent from whom they inherit it.
Let me explain, because I think we're getting a little bit in the weeds there. Okay, so if you have a healthy parent, you don't think a nursing home will be an issue, you want that property to be willed to the child or children, because at that point, if the home is worth $300,000, you now get that cost basis of $300,000. Meaning, if you sell it after their death for $300,000, you don't pay any capital gains tax.
Right.
It's at $300,000.
Exactly right.
But if you transfer the property because you're afraid of a nursing home, you transfer the property in your name, and there's no mortgage or anything on the property. Now you're paying capital gains on that $300,000, which would be maybe $60,000.
Right. Well, the 300 over and above what the parent's basis was, but traditionally it's been extremely low. Usually parents would buy a home, hold it for 40 or 50 years, and then it goes up. So a $300,000 home might have been purchased for $25,000 by the parent. So yeah, you are correct. For the most part, it'll be all taxable, right? And that'll be long-term capital gain, but still it's a pretty heavy price. And that rate is going to be,
it's like 23% or so.
Well, yeah, it probably won't be, if it's not a business property, it'll just be federal in Pennsylvania. So you're looking at about 18%. Philadelphia won't come in unless it's an investment property. But 18% is a lot higher than paying inheritance tax at 4.5% because it's a child. Yeah. So that's why if a nursing home is not in the equation, I much prefer the property being willed to the child or the children as opposed to an inter vivos transfer while the parents are alive.
Right, because now you're looking at the difference between 18% versus 4.5%.
Absolutely.
Especially on a $300,000, $400,000, $500,000, $600,000 property. That's a huge difference in the number.
Exactly right.
Perfect. Okay, so tax season is coming up, right? Everybody generally needs to do taxes. If somebody wanted to get a hold of you or want to know more about your services, they may own a business, that they need, they're tired of their accountant or they don't have one, how would they get a hold of you?
Okay, well, very easily. Our office phone is 215-755-9988. Our office is and street address is 1332 Jackson Street, right in South Philadelphia, between 13th and Broad. Landmark wise, we're right across from South Philadelphia High School. Jackson is 22 blocks south of Market Street, so 2200 South Broad. And best way too is through email at my first name Brian with an I, BRIAN CPA, the number 0, the number 1 at Gmail.
There you go. So tax season's coming up. If you own a business, you have real estate, you take advantage of all the deductions. Knowledge is king. You can save, a ton of money. And I do see taxes all the time. No tax expert, I can tell you that. But I see a lot of people making a lot of mistakes. So I sort of scratch my head saying, why didn't they take advantage of this deduction or that deduction?
Absolutely.
So Brian, thanks for being on the show.
Thank
Really
you. My
appreciate
pleasure.
it.
Thank you for having me. Merry
And-
Christmas to everybody.
Yep, absolutely.
Happy New Year.
Happy New Year. And just as a little disclosure, you actually do my taxes.
So I do.
You do my family's taxes. So we've known each other for
Yes, we have a long time.
many years, and I've called you many of times. Brian, can I do this? Can I do that? I'm not going to get in trouble. Am
That's
I?
right. And most of the time, the answer is no.
Okay. Well, that's the Real Estate Show with Pat Lopez. Be sure to follow the show on Facebook, Instagram, and subscribe below. Remember, this show is everything real estate. Also, leave a comment. Tell me some show topics you'd like me to cover in the future. Hope you enjoyed the show, and I will see you next week. Bye.